Fed Chair Jerome Powell doesn't make a big splash for financial markets, but economic data may do the heavy lifting for him as we look to U.S. inflation data. That's what we're going to focus on here on Macro Money. This is Ilya Spivak, head of Global Macro here at Tasty Live. And what we're going to unpick here is whether we have perhaps a little bit more impetus here on U.S. Fed policy expectations and what they might mean for the broader financial universe, stocks, currencies, bonds, etc. But of course, before we do, we need to first, it seems, take a look at where we started with these Powell comments, what they meant for us, if anything, and how that could translate going forward. So the first thing that we are going to do is just take a look at the way that the markets performed in the wake of Powell's remarks. He began 2 days of testimony here on Capitol Hill. He was in the Senate first. He'll be with the House of Representatives tomorrow. The prepared remarks are usually about the same for both, not surprisingly, but the Q&A is obviously going to be different because different policymakers will be asking different things. Powell managing to deftly walk the line here today with his remarks. We talked about this on the show yesterday as well as in some of our writing here for tastylive.com, looking at the outlook for the week yesterday. And the idea was that Powell was likely to walk the same sort of gradualist narrative forward that we've heard from him at the last policy announcement. And indeed, gradualism was the name of the game. Powell said that the Fed is in no hurry to move on rates with a view to make more progress on inflation, that is to say, on bringing inflation lower. That, of course, implies that there is a higher for longer kind of perspective from the Fed on rates. That is to say, they are not looking to up the speed of rate cuts. And moreover, Powell even went so far as to say that the labor market, which was ostensibly the reason why the Fed got so dovish back in September, that their concerns about it have diminished considerably, quote unquote, since mid-2024. That, of course, is a very interesting takeaway here for markets because what we end up with is essentially a goose egg from stocks. They don't end up finding a whole lot of lead out of all of this. S&P 500 flat, the NASDAQ just a touch lower. The real interesting bit here is what happens to yields. In fact, the action really has been in yields for the past several weeks. And what we find is the 10-year moves higher, the 2-year moves higher. So we get a little bit of a hawkish flavor from what Powell says, confirmed here a little bit by what we see in the yen. It comes down a little bit against a U.S. dollar that feels a little bit more muscular for yield-sensitive reasons, not surprisingly, with the whole curve shifting up a bit. Gold also coming in a little, that seemingly also a part of the same story. And so you look at the landscape here, and it seems like the markets ultimately took a slightly hawkish lead from Powell, but that this really didn't translate into broader risk sentiment very much. And for their part, we can see the bonds come in a little bit as yields show that tick up, but ultimately the trend higher from these early 2025 lows here, that remains intact. Moreover, the pullback marks a retest of this former support or former resistance become support, rather, right here about just above the 114 handle. And we stop just right there and hold what's very interesting about this is of course, this returns us to the site of last week's breakout to retest it, and marks at this point a retracement, not a change of trend. We're still looking at a series of higher highs, series of higher lows. We're still looking at a breakout from this down move here going back to early December. So it does still look like the bias remains higher, if not for today's price action in isolation than for the structure as a whole. Moreover, we've talked about the possibility that what this looks like is a head and shoulders pattern, where this is sort of a classic technical bottom, shoulder, head, shoulder. And if you believe such things, or at least if you were to take such things as a kind of self-fulfillment mechanism, that in my mind is how technical analysis is most potent, where everybody is looking at the same thing and trading on it as though it has meaning, and because it is then reflected in the price action and those actions actually move markets, well, then it has meaning whether it had it implicitly beforehand or not. The important thing is that the markets act on a thing and make it so. If you were to consider that here, then shoulder, head, shoulder with a neckline, again at this level just above 114, gives you an implied up move back over here into the 120 area. And so we were seemingly retesting the dividing line that confirmed that pattern here, but holding it perhaps to leave open the possibility that we're still going to see an extension upward. Now, for their part, stock markets remain listless. As we've sat in this range since early December, so too we remain, and in fact, the swings have seemingly coiled up even more. Now, in the wake of these Powell comments, we end up with Fed policy expectations that reshuffle slightly, but are ultimately unchanged in the grand total. So 54 basis points being baked in this year and next, 34 basis points for this year, which amounts to almost the two cuts that the Fed had in mind when it made its prognostications in December. We can see that here. The Fed anticipated that it would go from 4.4 to 3.9 on the median for the Fed funds rate. Of course, it is set in a range. So if 4.4 is the middle point between 4.25 and 4.5, which is of course where markets ended up, then what we're looking at when we see 3.9 is 50 basis points lower. That is between 4 and 3 and 3/4. So if this is what the markets had from the Fed, 50 basis points in cuts this year, and then down to 3.4, so another 50 basis points in cuts for next year, that's 100 basis points through the end of 2026. And what we see here is the markets are at about half that and have been at about half that, with this year leaning in the direction of maybe 2 cuts, and next year maybe 1 cut, but the outlook for this year looking light, and increasingly that second cut being pushed out into next year. Now, that's, again, a little bit more hawkish, but we can see that the markets have been very stable in their assessment. So there's not been much movement on this front. As a matter of fact, we can see that once the Fed had that very dovish September announcement that Powell was referencing today, the markets very quickly looked at it and said, yeah, that's way too dovish. That's not going to happen. The economy is too hot. Not to mention the November 6th election result gave us the ascent of the Trump administration, which the markets judged as likely to be a tailwind for inflation, both on growth grounds, lower taxes, in particular lower corporate taxes, and deregulation, in so much as they tend to boost growth, but also tend to boost inflation. Moreover, the markets were very clearly concerned that you might see the tariff piece of the Trump administration's economic agenda, as well as the immigration piece, to the extent that it oversees a large deportation effort and thereby disrupts labor markets, that these things would be basically a sales tax on imports and an upward shock on the price of labor, and therefore on the price of doing things with labor, which is most things. And so that would be inflation on top of the growth geared kind. So with all of that, the markets already by November the 7th readjusted to a much less dovish view of where rates are going. And we can see since then, we've only just tinkered around the margins. So we went a little bit more hawkish of this in the December announcement, when the Fed essentially made official its revision on rates. We can see in September, the Fed thought from 4.4 to 3.4 in 2025, and then down to 2.9 already by 2026. At the December revision, 2.9 is nowhere in the outlook, not even out to 2027. So we can see that where there was 3.4 as the destination for this year, it's been pushed out by a year to 2026. So clearly, the Fed endorsed this adjustment. And since then, very little has actually occurred. And so looking at that in context, and of course hearing Powell endorse it again and the markets listen again and go not very far at all, the question then becomes, well, then what's this rally in yields all about? Or rally in bonds, rather, sell-off in yields, all about. And why is it occurring when, in fact, nothing has really changed for the Fed, and Powell just reiterated that it probably won't anytime in the immediate future? Well, this then comes down to what we were just discussing and on the show yesterday, and really the makings of this rally. We just said that the way that this head and shoulders would-be pattern came together was last week with this breakout, this green candle right there. And as a matter of fact, if we look at the meat of this rise, it's really only 3 trading days, and of those 3, really only 2 that make up the bulk of what's going on here. Consider, this pop right here is the previous month's CPI report. That's what forms us this low just above 110. This right here is last week's PMI reporting, and this bit in the middle, which ultimately ends up with some digestion and not much forward progress in its immediate aftermath, this is the DeepSeek news, where the markets clearly took a bit of a risk off tilt, and that of course helped bonds higher. But it's really these 2 candles here that account for the meat of this entire rise. Now, the explanation that we heard from Fed Chair Jerome Powell today, again, by the way, he said something similar after the Fed's January meeting at that press conference, that the rise in long end yields, that is to say, this, is more about risk of uncertainty downwind, that this is not the Fed, that what this is what he called term premium. That is to say, the premium that investors demand, the extra income that they demand, the extra yield that they demand, for lending at longer dated maturities. That is to say, because there is uncertainty about where the correct borrowing cost level is as you go out in time. Now, sure, maybe that's not an unreasonable perspective, but of course the question then becomes, well, why are we uncertain, and what kind of uncertainty is animating this? And what these moves would suggest is that as we move higher on the bond structure here, it isn't so much easing uncertainty as it is a growth concern that seems to be emerging. And that's because this move right here follows that CPI number where core inflation came in just a touch lighter than expected, but more importantly, the breakout, last week's decisive move that we are currently testing the wherewithal of, that move came after disappointing PMI data. And what we saw there, PMI, of course, a kind of approximation of the trends that GDP will ultimately trace out, and looks further afield beyond current conditions. This is, of course, a survey of purchasing managers, hence PM in the PMI. And their job is to look 6, 9, 12 months forward and decide inventory levels and decide outlays and budgeting. And of course, that requires an opinion on the future. And what they said in the survey that was just updated for January is that U.S. economic activity growth has slowed to the weakest in a year, primarily because of a downturn in the critical service sector. And so it would seem that what the bonds are telling us here, in particular with this surge, is that it isn't so much that there is easing uncertainty. It is more like the Fed is reluctant to cut now, and the markets are saying, well, if 6, 9, 12 months down wind, the business cycle is doing this, then the Fed's reluctance to move sooner means they're going to have to move more later. And rates are going to have to be weaker. This, of course, is the perfect backdrop to be caring about this incoming CPI report. Not surprisingly here, the expectation is that most inflation remains locked in the service sector, which is why that PMI drop-off is so significant. This is very much the essence of U.S. economic growth here, and of course, by extension, global economic growth, because the U.S. has vastly outperformed every other major economy, and which is not to say anything at all about China, which has been basically at standstill since reopening from COVID restrictions. And so really the U.S. service sector is the essence of the global growth game at this point. So we can see there's next to nothing here by way of demand pull inflation from the goods side. That inflation is next to zero. Energy, that contribution has rebased next to zero, and that's why we've had this slide up in the headline. That's expected to hold unchanged here at 2.9%, but the core is seen ticking lower from 3.2 to 3.1%. That would amount to the weakest core inflation since April 2021. Now, it would be tacit progress, but is that something that's likely to get the Fed to move quickly on rate cuts? Well, hearing Powell speak, the answer is no. Now, looking at the lead-in here, the ISM numbers that we had last week, we can see the price component there seemingly endorses a bit of a downtick on inflation. That critical service sector component, that's this green line right here, showed that the pace of inflation cooled, still positive, of course, but cooled in January. There's a little bit more pep on the manufacturing side, but that, of course, is a very small part of the economy at this point. We're talking about something like a 70-20 split at this point, where about 70% of the U.S. economy is the service sector, and only something like 20% is manufacturing, with the rest falling to ag. And so we have a reasonable argument to say that perhaps core inflation cooled a bit last month, but certainly not to say that it's moved aggressively off the recent averages. Moreover, if we look at the Fed's higher frequency metrics that it likes to look at for where inflation is trending, and we're really focused on the core because what's going on at the headline is largely driven by that overlay of energy and food, and those things are volatile, and the Fed has no agency over them. So it's really that service sector core bit that matters. We can see here that in particular, the 6-month annualized rate for month-on-month changes in core CPI, that's showing us that over a 6-month horizon, inflation is actually accelerating, or the annualized rate of inflation is accelerating. Helpfully, there seems to have been a downtick in December for the 3-month rate, and that's in part why we got the response from bonds that we did right here. But it's still a mixed picture, and not one that, at least, again, hearing Jay Powell today, gives the Fed any confidence to move anywhere quickly and with strong conviction. Moreover, if we look at the Citi Economic Surprise Index, we can see that the recent path of U.S. economic data has broadly tended to side increasingly close with expectations. When this index comes back in the direction of zero, what that essentially implies is that incoming economic data is, broadly speaking, registering in line with forecasts, that essentially surprise risk is relatively low. So chances are we land at something in this ballpark. And of course, if that happens, then the question becomes, well, okay, so that means the Fed is probably still as anchored as Powell implied. Certainly no hurry to move there. So it probably leaves policy expectations generally in this range. But then, of course, for the bond market, the upshot remains the same. That with this, what we end up with is higher for longer now. That then means lower faster later. And we get further on this move in the long end. Bonds go up, yields come in. That may well be a headwind for the U.S. dollar. But of course, the real question is, what does that do for overall sentiment? And does it ultimately get stocks off their perch here and get them to move in a direction? Now, if the upshot becomes, with relatively in-line numbers, that the Fed is, in fact, running the risk of missing the boat on cuts, and this actually gets the market animated with some sort of a cyclical concern, then perhaps you could start a move lower here if, again, stocks are prepared to worry about such things. On the other hand, if not, then perhaps you remain here until some sort of conviction emerges. Perhaps the most potent risk for markets here, which clearly opted not to get scared when Powell made the case for delaying rate cuts today, is that CPI is actually a little bit softer. And the conventional wisdom would be, oh, well, goody, it's softer, they might cut sooner. But if the market has become animated by a cyclical concern, as this would imply, especially given how we got here and what the catalysts were, PMI data most recently, then a soft result may actually end up with a more acute concern about where the economy is going, about recession winds gathering in the second half of the year, and about what that could mean for risk. Now, that makes looking at how the CPI numbers come out and the subsequent market reaction, no matter what the numbers are, incredibly instructive. If you get a weak number and stocks don't like it, well, then we know where their head is at. If you get a weak number and the markets do like it, we get that as well. And we get a reenacting of our dynamics that we saw toward the end of last year. If we get a hot number and the markets like it, well, then it is, in fact, cyclicality that's on their mind. And if we get a hot number and the markets don't like it, well, then we've learned something yet again. So the interplay between what happens with this range in response to whatever happens in the bond market, in response to whatever happens in the CPI report, a potentially defining catalyst here. Not just for bonds, not just for the dollar, not just for rates, but for risk sentiment writ large. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris for Futures Power Hour Mondays and Fridays. In just 30 minutes time here, I will be on, as I am every Tuesday, with Victor Jones for The Price of Truth. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.